We see that I believe that the LME supply on the copper in the LME went up five-fold in the last number of months. At the same time, the copper price doubled at that time. So it's sort of strange. It seems like maybe there is a hoarding phenomenon going on where the Chinese are trading in their worthless pieces of paper for something that's tangible.
Cash copper in China is trading between 250 and 260.
One needs to be careful here about what's going on in China and why. And there's this been argument that's been going on for the last several years. Well, what if China does this, and what if China divests out of its U.S. dollars? The reality of the situation is, mathematically, if the U.S. is running a trade deficit, some other countries are going to be running a trade surplus. That main trade surplus country happens to be China. So mathematically, they are accumulating dollars. It's just a simple mathematical fact. They can't get rid of them. They can get rid of them and say, well, what if they buy oil? Well, then what does Saudi Arabia do with the dollars? So the fact that the U.S. is running a trade deficit means that someone has to be accumulating those dollars. And as long as that trade deficit continues, someone is going to be accumulating dollars. It has to be that way mathematically. So you see all of these arguments out there. Well, China's going to dump, China's going to do this, China's going to do that. Well, what we're seeing recently is the trade deficit is starting to come in, mainly on the collapse of prices of oil. We're also seeing less U.S. imports coming from China. So that is one of the reasons why China, mathematically, needs to do something differently than they have been doing before, so they don't need to accumulate as many treasuries. And so there's this big idea out there. You see it on all of the gold sites, on all of the silver sites. Look at this. China's going to dump this. You have to remember, mathematically, they have to accumulate these dollars as a result of a trade deficit. It's a simple mathematical fact, and most people have this completely wrong about why China is doing what it's doing and why.
What does that mean?
What does it mean? Well, we've got a huge imbalance here. Everyone understands that the global economy is imbalanced. We're now starting to see some semblance of some sort of correction to that. We're seeing interest rates fall. Bernanke slashed them to zero. We're seeing interest rates head towards zero in the UK. Interest rates are zero in Japan. Australia's going to cut again. Jean-Claude Trichet at the ECB is cutting again, so they're going to be under 1 probably within a few months or so. So that's going to eliminate all the various carry trades. We can say for certain that the U.S. dollar hegemony, the U.S. dollar, the world's reserve currency, this is going to end. There's absolutely no question that this is going to end. What we don't know is when it's going to end or how it's going to end, but there's likely to be a violent shakeup here. Unfortunately, I wish I could tell you when that's going to happen, but the U.S. dollar as the world's reserve currency is coming to an end. Claude, got any comment on that?
Yeah, I probably said it the first time I was at this conference, that the U.S. has had a tremendous advantage for years as a world reserve currency of being able to exchange little pieces of paper that our government produces without any intelligence, any sweat, any productivity whatsoever, in exchange for Toyotas, Sonys, and trinkets at Walmart. And that eventually that trade will go into reverse. We will get our paper back and have to return real assets. That trade is reversing now, and it will be horrible for the United States. We will have to become productive again. It's going to make a great, great difference in the next 5-7 years. How it unfolds in various markets, I don't know. As a trader, if the dollar breaks 70, I will short it like Kool-Aid the rail. If treasuries break, the 10-year treasury breaks 310, I will buy TBT as much as I can get my hands on that day.
What is TBT?
TBT is a double reverse bond index. These are things that until things happen, they're not happening. I've told this crowd numerous times, when you read a book about the '29 crash, you read it in 2 hours and you think that's when it took place. It didn't. It took years to unfold. The giant changes that are going on now will take years to unfold, but you have break points in various markets to tell you it is now breaking through the historical numbers. Be really careful. And we're starting to see that. I've been telling people there's 2 things to do, in my opinion, as a U.S. citizen today. One is 100 days we have switched from the parasite, the government, has outgrown the host, us. This is a giant change for us and our children. We no longer can afford the government that we're getting. So this will make huge changes in our lifestyle. And secondly, for all the people looking for a bounce in the U.S. stock market, buy yourself a 20-year chart of the Japanese stock market. In '89, it was 39,000. They went to 0 interest rates. They went to quantitative easing 8 years ago. They've had millions and billions and billions of infrastructure projects, and the market is under 9,000. Don't think it's not going to unfold here the same way. We are on the same course, all the Mickey Mouse coming out of Washington, that more debt and credit is going to fix too much debt and credit is absolutely asinine. We're at the point where we're saying, okay, I'll give the alcoholic 1 more fifth because he'll feel better. We are not on a good trajectory here. I'm very sorry to say.
We're worse. We don't have any savings.
Oh yeah, Japan had a trade surplus, a savings rate of above 10%, and a government surplus in '89 when it started to unfold there.
Not anymore.
Not anymore. But in all 3 cases, we're starting in a worse position.
Clyde, you know, at the last luncheon, I asked you, the panel.
I was wrong again?
Yeah, I was wrong, but I want to put this in perspective because you were wrong to the tune of about $14 trillion. I asked the panel, with these credit default swaps and all these, you know, option arms and all this stuff, where was this going to end? And you said probably $1 trillion. It's $14 trillion.
Yeah, I was a little light.
And just yesterday I read the difference in the income from the February to the March corporate taxes dropped 90%. That is breathtaking.
And I've been preaching.
Why is the stock market where we're at?
Well, things rally. If you look at the history of the Japanese stock market, on its way from 39,000 to 7,000, there were numerous 50% or 100% rallies. We've got a rally here in the United States of what, 30% or so. Perhaps it goes on, perhaps it doesn't. We see indications that that this rally is running out of steam, and one of the things that we look at most is breath indicator. Is various breath indicators. But this is not a call to go out and wildly short or anything. This is a call to be cautious, because Japan had, like I said, numerous 100% rallies all the way down, and I firmly believe that, and I've been saying it for 3 years, that the U.S. was following the Japanese model. And the huge irony in all of this is that Greenspan, Bernanke, over the last, looking back 3, 4, 5 years ago, were all chastising Japan for not writing off the debts, not writing off the bank failures. What is the United States doing? We're following in the exact same path that Japan did. We're not writing off the defaults. We're worse. We're charging. We're putting this on the backs of the taxpayers. And they think this is going to work. They think that we're going to bail out the banks and that the banks are going to start lending. Who are the banks going to lend to? We don't need any more Pizza Huts. We don't need any more Walmarts. We don't need any more Home Depots. We don't need any more nail salons. So what is it exactly that the banks are supposed to lend to?
I'm going to interrupt you. I'd like a closer White Castle to my house.